Hello everybody, welcome back to my channel. So ESR-Logos Reit. I'm not sure why they didn't rename the reader to ESR-Logos Reit. Maybe it was a oversight when preparing the slides. But this Reit has just completed the merger. So I titled this video, What Happens After Two Become One? So this is of course a play on a certain song. La 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 la. And I was just very interested to see the numbers after the merger and how they held up against the Proforma projections and stuff. And this is a very long set of slides to go through. There are 65 pages of slides, and the words are extremely dense. So wow, it took quite a while to go through everything, but I'm glad I did. So let's go through the presentation. So this was the slides that was used for the EGMs to show the pro forma impact on the DPU post merger. So you can see that there's an accretion based on the terms, and the projected pro forma DPU will be around 2.9 cents on an annualized basis. And you can see that by right, they're saying that the cost of loan to go down and so on and so forth. So I want to see if the numbers really did play out. And this was the DPU figures. So for the first half of 2022, total DPU was 146. But this was pre-merger, right? And the merger was done in 22nd of April 22 when it became effective. So the combined entity had the number over here, this box, right? So this was pre-merger, right? And this is post-merger. And for this period, the DPU was a 0.55 cents. And remember that the projection back then was 2.9 cents, right? So I did a very rough estimation. So from 22nd of April to 30th of June is around 2 months plus a 1 week plus, right? So that's around 2.25 of a month, right? So if you analyze it, so 12 months divided by 2.25 of a month times 0.55, you get 2.93, right? So actually this is quite very much in line with the projections that they did. The pro forma projections done during the EGMs. Of course, I know this method is extremely rough, right? Extremely estimated. It's very agar-agar, but it's roughly there lah. So I think that's the main thing that I was interested in to see what they projected back then. Did it actually play out? And I think roughly it did. That's the first conclusion. Unfortunately, they'll be changing the frequency of the distributions from quarterly to half-yearly basis. I'm not in love with it because actually I like REITs that give you quarterly dividends. And I think the markets actually do. But unfortunately, they want to do it this way. Too bad. So these are the highlights. You can see this is what I mentioned just now. Imagine actually this REIT, right? It actually gives a lot of information. So you can see each slide is damn dense with words, super dense. As I mentioned, there were 65 slides. So going through them was a Herculean effort actually. But I'm just gonna highlight a few things. I think first of all, this is quite a strong set of numbers. The rental reversion was 11.4%. That's quite surprising. At least I was surprised. But I'll talk about the market dynamics subsequently, and I think for a better picture. Likewise, the NAV and revaluation also had a jump. Especially the stuff in Australia. So you can see that the stuff are revaluating from 7 to 10% because they had the Australian physical assets and they also had a fund that they invested in, right? So these two stuff had a pretty sizable valuation uplifts. So I think the Australia dynamics for the warehouses and stuff looks really good. And there's a bit of a measure to mitigate the rising utility rates. Because you know in Singapore there was a huge jump in electricity rates. So the extent that actually some people, some commercial entities couldn't even get a contract from the Gencos anymore. So it was a big problem. So there are some mitigation factors over here. And of course, we'll talk about the capital management and the impact of interest rates. Because unless you're living on Mars, otherwise you will know that the rates are rising really fast. In fact, just yesterday, the Fed raised rates by 75 basis points. So let's talk about it subsequently as well. So quite a fair bit to talk about. So this is the market dynamic, which I thought was quite interesting. So you can see that this is the supply in the blue bars, and So of course, during COVID, the supply really dropped, right? Because everything had to come to a halt. And in 2022, there was a big jump up in supply, but it seems to be pretty well absorbed. You get it, a bunch of it is really pre-committed. And subsequently for the next few years, actually the supply is going to be really small. And in particular, I look at this light blue column, warehouses, right? So other than this one and this one, actually there's not a lot of warehouses coming on stream in Singapore. And if you look at the rental index, it's also jumping up, right? I think it's a reflection of the lack of the supply demand imbalance. So supply is kind of going down, while demand is still going strong. So the index is going higher. I thought the index would be was a huge jump, but actually I think the graphical impression gave a larger jump than what the numbers really showed. So it's going from like 90 to like maybe 92, 93. So something like a 2 plus 3% jump, right? So I mean when I first look at this green line, I thought it's like a massive jump, but actually it's like something like 3%. Well, it's still a decent jump, I guess. So if you look at the Australia situation, it's also the same. Supply, demand, and look at the over here, the industrial and logistic rates are going up. Uh, the vacancy rate is going down. So I think there's also a demand supply imbalance in Australia. So rental rates are going up, I think. Similarly for high specs, it's also pretty decent. Look at the rental index also going up. So if you look at the warehouse projections for logistics, if they do a survey, 80% of them are expected to expand. So again, the demand is strong, right? And the supply seems not to be catching up. Maybe because of disruptions due to COVID or something. But the overall logistics dynamic in Singapore and Australia looks pretty strong. Likewise, if you look at the rental rates for the industrials, um, so the dark blue lines are the current passing rents, right? And the grey ones are the market rents. So you can see that the markets are always higher than passing rents, right? In almost all four categories. So when it's time to renew the leases, it looks like there's possibility for rental uplifts for this stuff. So that's pretty decent. And over here, there's the mitigation factors for utilities. Apparently, they're going to roll out some service charges at 15%. So trying to pass on some of these inflationary aspects, right? And some conversions of the utilities to SP. So a bit of a mitigation. But you can mitigate part of it. But at the end of the day, when electricity prices go up and energy prices go up, they have to pay more. Simple as that. But at least some mitigation stuff in place, right? Of course, interest rate impacts, and they give you the sensitivity analysis over here. For every 25 basis points increase, DPU impact is 0.7%. So if it's a 1% rise in a hike in interest rates, I think the impact will be like 3%. That's because 66% is fixed for the debt. So there's some floating rates here, right? But the debt refinancing looks quite okay. In 2022, they've already refied everything. So there's this block in 23 that they look to refi. But I think the dynamics is also quite interesting. If you look at the all-in cost of debt, in December last year, it was 3.31. And as of June this year, actually it's gone down to 3%. That's a bit surprising, right? Because rates have been jumping up like mad. So for this guy, the cost of debt has actually gone down. So I guess it's part of the benefits of the merger. And when you get bigger and there's a stronger sponsor, and actually the assets profile also look to have a favorable dynamic, right? So I think while interest rates go up, affecting their cost of debt, I think their cost of credit might be going down because of their larger scale. So there's some offsetting here and there, plus and minus. I'm not sure what the net effect would be though. But it looks well, a bit plus, a bit minus, right? At least it's not like negatives all over the place, right? Gearing is a bit high on the 40 plus % side. But if they can get some positive valuations, revaluation higher for the assets, maybe the NAV, maybe the gearing ratio will go down a little bit naturally. So that depends on the valuation front. But overall, I think the debt profile looks decently managed against the impacts of rate hikes. So well done, blokes. So finally, I think this is the interesting stuff that I didn't realize until I read it in the papers. In fact, I think it wasn't very well publicized in the SGX announcements, which is the change in the management. So this is the Business Times reporting, right? And apparently the ESR Group bought over the a part of the stake in the manager. So the manager is different from the REIT, right? This is the management stake. And now ESR has 90% of the manager, so they are like a super majority already. I think that's a good thing to have a more focused manager, so which is in ESR now, right? ESR, if you didn't know, is listed in Hong Kong. So if you're interested in this guy, you can just check out the numbers in Hong Kong. In addition, they're gonna buy a bunch of units in ESR-Logos from this Mr. Tong guy. Um, and you'll be the largest shareholder at 14.4%. So if you look at the shareholding structure that they presented during the EGM, currently, last time ESR had 11.5%, and Summit Group, which is the group led by this Mr. Tong, had 12.6%, while the minorities had around 76, right? 76%. So after this stake sale, ESR will have 14.4%. So that's a 3% jump, right? So meaning this guy will go down by 3%. So now that this is a transaction, ESR will have around 14.4%. Summit Group will have like a 9.6%, and the minorities continue to hold the same. I think this is a good thing. There's like a more concentrated focus from the ESR Group in the manager, and now there's more skin in the game in the REIT from the sponsor, right? So I think that's a good development. But of course, the future remains to be seen whether or not the ESR, the sponsor, can drive accretions for this guy. There's a lot of levers you can pull actually. Buy more stakes in the Australian properties and the Australian funds, doing AIs, redevelopments, BTSs, so on and so forth. So I think the future of this fella, after two becomes one, remains to be seen, and I look forward to seeing the next update. So we've come to the end of this video. If you like what you saw, thank you very much for spending some time. Remember to subscribe over here, like, share, and comment. I'll see you very soon.